Hi, good morning, everyone. Welcome to our Blip Securities Research Morning Call for today. We have a few stock counter updates as well as results and video on the ground for Wilmar. For technical analysis, we have S&P 500, ETF Mali, as well as Thai SDR Mali, and we will end it off with the Singapore Weekly. So these are our disclaimer. This is only for educational purposes and should not be considered as financial advice. So without further ado, I'll hand over time over to Glenn to get us started on Alphabet's results. Thanks.
Hey, thanks, Zane. Yeah, so we just start with Alphabet's third quarter results. So Alphabet, otherwise known as Google, released their third quarter results, and we titled it "Effectively Monetizing AI Investments." So this is by John, but he's on leave, so I'll just be covering him for this briefing. Yeah, so to start off, the third quarter revenue as well as the PATMI was higher than our estimates. For revenue-wise, it was mainly due to higher cloud demand. As for the PATMI, it was also due to the higher cloud profitability and continued focus on cost efficiencies. For the 9-month revenue and PATMI, it was at 73% and 77% of our FY24 forecast, respectively. Now moving on straight to the positives. The first positive is that the cloud surged 35% year on year, and this is the largest growth in 2 years. So largest year-on-year increase since third quarter of 2022, which is also helped to alleviate some of the investor concerns surrounding their returns from AI. Whether is it just all hype or is there any sort of profitability to be gained from AI? So it's a suite of AI-powered solutions were able to be the key drivers in attracting new customers as well as supporting larger deal wins. Their cloud revenue was up 10% quarter on quarter, and their operating margins also rose 17%, and it contributed to 2 percentage points to their third quarter total operating margins expansion. We continue to anticipate there will be sequential growth for cloud due to the advancements of AI, and also raise our FY25 cloud revenue forecast by 12% to $58 billion. The second positive is that their advertising is resilient and there's stronger engagement on AI overview. So advertising growth has remained resilient at a growth rate of around 10% year on year, with both search and YouTube growth rate around 12% for both of them equally. And their advertising has also benefited from some of the election-related political spending. They have highlighted that their AI overview, which is powered by Gemini, as one of the main products which is driving their growth. And this is increasing overall search usage as users ask deeper and more complex questions. So this actually potentially creates more significant opportunities for future monetization. And I think Google is able to effectively demonstrate how is it turning AI technology into a tangible product, improvements, as well as most importantly, the monetization aspect of it. And last but not least, on the cost side, the last positive is that they are able to maintain their costs, and this will imply more margin upside. So their OPEX growth was quite low at only 5% year on year. And they do remain committed to keeping their costs down. For the negative, there's only one negative, which is that there will be potentially higher capex going into FY25. So for FY24, for the fourth quarter, they expect around $13 billion for fourth quarter, and this will be around $51 billion total capex for FY24. So hearing from their CFO, they said that there is a potentially an additional increase in FY25, and we expect it will be close to $60 billion, so an 18% year-on-year increase, and this is 12% higher than our previous estimates. So this increased capex could be a slight near-term drag on their valuations. As for outlook, this is a good set of earnings for Google, and better than expected cloud growth was a huge positive, giving investors some indication of what to expect from the AI-related revenue that has benefited both the top and bottom lines. We also believe that their AI leadership remains the key differentiator for the company, with a margin upside due to increasing profitability as well as contribution from their clouds business. We do upgrade to a buy with a raised target price of $240 from $205, as we keep our FY24 revenue unchanged but increase the PATMI by 5%, mainly due to the improving efficiencies, lower costs, as well as higher profitability from the cloud. We remain positive on Google's ability to deliver almost instant ROI on its AI investments. So that's all I have for Google and Alphabet. I'll now hand it over to Ambrish for PayPal. Thank you.
Thank you, Glenn, and good morning, everyone. So last week we released a report on PayPal's third quarter 2024 results with the title Margin Expansion Still the Main Story. Next slide, please. So PayPal, it's basically a fintech company, and it generates most of its revenues by charging certain transaction fees for the payment that have been processed on its platforms. So overall, the third quarter results were mixed, with 9 months 2024 revenue coming in at about 73% of our full year forecasts, whereas earnings they exceeded as the adjusted PATMI came in at about 80% of the full year 2024 forecasts. Moving on to the positives for PayPal, the gross margin they continued to show improvement. So it basically in the third quarter expanded by about 100 basis point to about 47%. And this is the first year-over-year improvement since the third quarter of 2021. And we believe that this is mainly because of the continued consumer spending. It has been remained resilient. So overall, for the third quarter, the total payments volumes on its platform it surged by about 9% on a year-over-year basis to 423 billion US dollars. And the most of the strength came from its two products, which are basically the core legacy product, which is branded checkout, and its Braintree segment. So the payment volumes for branded checkout they grew by about 6%, whereas for Braintree it basically surged by about 19% on a year-over-year basis. And this basically Braintree is basically a payments service solutions provider to the e-commerce companies like Airbnb. And secondly, for PayPal, it's also focusing on increasing its user engagement instead of actively acquiring new users. And as a result, its number of payment transactions per user it grew by about 9% on a year-over-year basis to about 61 times. And this is mainly because PayPal it has been continuously adding in new features like it has been like integrating passkeys for users, as well as it recently introduced a fast lane, which is basically a one-click checkout for the users. And we believe that this should lead to higher payment volumes, and the number of users for merchants they get a faster conversion rates. And lastly, the last positive is that operating margin it expanded by about 200 basis point to about 18%, and this is mainly because of higher than expected gross margins, as well as continued cost cutting initiatives like job cuts and real estate consolidation. And in terms of negatives, we believe that for the fourth quarter of 2024, the company provided a soft revenue outlook, and it expects revenue to grow by about a low single digit. And this is basically a sequential drop, as well as drop as well as below the consensus estimates of 5% growth rate. And we believe that the revenue drop in the fourth quarter is mainly because of shift from Braintree unit to its higher margin business, which is branded checkout. And as a result, its revenue growth is expected to drop, and volumes are expected to drop throughout 2025, since they are expecting to it has changed its pricing strategy, and we believe that it should lead to higher margin in 2025. But in 2024, in terms of bottom line, it expects its earnings to drop by about 4%, mainly because it said that it plans to invest more into its marketing related expenditures, mainly to promote its recently launched product, which is a service, which is a fast lane. And overall, in terms of valuations, we downgrade the stock from buy to accumulate, and mainly to account the share price performance. And but we increased our target price to $90 from $80, mainly because for the full year 2024 we increased our adjusted PATMI by about 5% to for the lower expenses. And overall, we believe that PayPal it's well positioned to benefit from its strong user base of about 432 million user base across the regions and countries, and also it should benefit from a shift to e-commerce, as well as we believe that the drop in interest rate it could lead to higher consumer spending, and as a result it could generate higher transaction fees in 2025. So overall, we have accumulate on PayPal and a target price of $90. So that's all for me. Would now like to pass it on to Darren.
Thanks, Ambrish. Yeah, so I'll run through Capitaland and Ascott Trust's third quarter results. So for them, their portfolio constitution is bearing fruit. So we've seen it from their third quarter gross profit. So it's up 8% year-on-year. If you exclude the portfolio reconstitution efforts, which include divestments and acquisitions, the gross profit was up 2% year-on-year. So for their portfolio RevPAR, it continues to improve despite the high base in 2023. So you saw the third quarter RevPAR grow by 3%. So now it's at 5% above pre-COVID levels. So when looking towards the top part of there's one table there, we see that all of the core markets. So Class has 5 core markets, including excluding France. So these core markets contribute about 80% of their total income. So for these 5 markets seen here, all of them experience RevPAR growth except for Australia. So the reason why Australia experienced an 11% decline was due to the fact that in 2023 third quarter they had the FIFA Women's World Cup. So as a result of the lighter event schedule this year, or rather this past third quarter, and there was a slight dip in portfolio RevPAR. But the positive is that for them, higher occupancy continues to portfolio occupancy continues to improve. So now it's at 79%. So pre-COVID, it is this 79% is about 92% of pre-COVID level. So there's still some room for it to grow for occupancy. Third quarter last year, occupancy was only at 77%. Yeah, so for them, for France, because France is under master lease structure, so for France, it saw 11% jump in revenue. So that's mainly due to the fact that they renewed 8 leases last year and this year. And the performance in France was also boosted by the Paris Olympic Games. So this year just in the third quarter, they renewed the 3 remaining leases that were due this year. So they've been renewed at a 4% higher rent as compared to 2023 levels, where it included a fixed and variable portion. But now when they renew it, it's 4% higher than 2023's number, even though it's a pure fixed rent now that they've renewed it to. Yeah, so for the capital management, it continues to be stable, gearing stable at 38%, and the cost of borrowing for them is expected to remain around 3% into FY25. So for their, like I mentioned, their portfolio efforts are taking shape and is really bearing fruit. So year to date, we've seen 500 million in divestments, all of them at premium to book values. So this has helped them to unlock about 60 million in capital gains. So with this 60 million, altogether, they have over 300 million that they can of previous divestment gains that they can use to top up their DPU. Yeah, and they also have 350 million in investments year to date. So the latest one was the proposed acquisition of Life Funan at an EBITDA yield of 4.7%. Yeah, they also have some AEI projects that are expected to start next year, and they have completed 5 AI projects this year as well. So all these will start contributing. And for the negative, like I mentioned previously, is just that the fact that the ADR growth is expected to stabilize. So we think there's limited room for ADR growth because right now it's already at 15% above pre-COVID levels. So future growth in RevPAR will likely come from just improvement in occupancy. So right now for the outlook for Class, they are focused on portfolio reconstitution, basically divesting more mature assets and to reinvest some of these proceeds into more optimal users. And they also have that 300 over million divestment gains that they can use to top up their DPU when some of the AI projects, their upcoming starts. So basically there will be some loss of income there, so they can use this to top up. And right now, China accounted for 8.5% of the total guest count, compared to about 11% in 2023 third quarter. But we've seen the revenue contribution from Chinese guests already match pre-COVID levels. So that just means that the Chinese are spending more relatively. And for Singapore, we're seeing some softening in demand, but Class's geographical diversification is likely to offset this. So I'll leave the Singapore outlook for RevPAR to Myanmar when she talks about FEHG, but basically in the absence of a lot of major events that we've seen this year, like Ed Sheeran, Coldplay, Taylor Swift and such. So next year, there's a bit softening in the event schedule, or lesser event schedule, so there might be some weakness. Yeah, so we maintain our DDMTP, no change in our estimates. The Forward yield is at 6.6%. And we have not included any capital gain top up. So any capital gain top up will be further upside for class. Yeah, next slide, please. Yeah, so for first REIT, they were really hurt by the weak Indonesian rupiah and Japanese yen. So for the 9-month 2024 versus 2023, the Indonesian rupiah depreciated by 4%, while the Japanese yen depreciated by 11%. So that really hit the gross revenue for them and DPU as well. So their DPU for third quarter, it was down 6.5% to 0.58 cents. It's also down 3.3% quarter on quarter to that 0.58 cents. That's mainly because of the weaker foreign exchange. And this increase in DPU, however, was exactly in line with our estimates. So yeah, we already anticipated the fact that they'll be hit by the FX. Yeah, so for the positives, the rental growth still continues to improve in local currency terms. So in Indonesia, it's up 4.4%. Singapore grew 2%. Yeah, and Siloam's contribution has ticked up slightly for 9 months to 57.6%. First half, it was about 56%. So going forward, this Siloam's contribution will continue to improve. This is expected to reach over 80% by 2026, assuming performance-based rent is hit. And for the capital management, everything remains relatively stable. The cost of debt is expected to remain at 5% for the rest of this year, and next year is likely to decrease slightly because 30% of their interest rate hedges in Sing dollar will roll off by the end of 2024. So it's likely to have some benefit from the lower interest rates next year. And for the foreign source income that they hedge, right now they hedge about 40% of the Indonesian rupiah, and the Japanese yen is fully hedged until end 2025. Yeah, and for the negatives for first REIT, there's rental owed by MPU. It totaled to 7.8 million. They do have some security deposits from Siloam and MPU, which totaled 4.3 and 2.3%, 4.3 and 2.3 million respectively. So if you net that off, the amount owed is still 1.3 million. Yeah, and management is still in active discussion for repayment schedule, and likely repayment will happen when MPU can divest some of their assets to free up some liquidity so that they can pay off the debt that they owe. And for the outlook for First REIT, they are still focused on their main First REIT 2.0 growth strategy, which includes a more than 50% target in developed markets by 2027. So how they can achieve this is by divesting some assets in Indonesia, like the hotel and country club and some of the weaker hospitals as well. And they will redeploy these proceeds, divestment proceeds, into acquisitions in Australia and Japan. So these are the two countries that they're looking at. And for IAHCC, which is the hotel and country club asset that they've been trying to divest for quite some time now, the lease was extended for another year, so it will be until December 2025 at a 4.5% rental uplift. So they've noted some demand from several parties also. So we think it is likely that they'll be able to divest this asset by next year, we think. And they've reiterated that they will not sell this asset below valuation. Yeah, so that no change to our target price and no change to our estimates as well. And First REIT still pays an attractive dividend yield of 8.9%. Yeah, so that's all for me. I'll hand over time to Meow Meow to talk about FAST. Thanks.
Thank you, Darren. So Far East Hospitality Trust released the third quarter result last week. Next slide, please. DPU was not disclosed, but the results are mostly in line with our expectations. We identified two positives. Firstly, is ADR has been insulated from the downward industry trend due to a lower base in 2023, when several hotels were operated under government contracts at below market ADR. And with all the hotels now off government contracts, ADR rose by 4.2% year-on-year, while occupancy dipped slightly by 1.2 percentage point to 85.5%. RevPAR increased by 2.8% year-on-year, and forward booking for fourth quarter 2024 appears healthy as Christmas and New Year's booking are coming in, and we expect hotel revenue to return to growth, given the absence of the one-off income in fourth quarter last year and positive ADR growth trend. And RevPAR for service residents increased by 2.5% year-on-year, as ADR rose by 3.3% to $278, driven by higher proportion of the longer stay guests. Far East is negotiating more corporate contracts with no signs of the rate declining. We expect steady improvements in occupancy as corporate confidence may resume following further Fed rate cut and improve macro economy and stabilize geopolitical tension in 2025. And revenue from commercial premises increased by 8% year-on-year to 13 million in 9 months 2024, driven by new F&B concepts that boosted occupancy and also rental rates. We anticipate rental reversion to remain in mid-single digit in 2025, supported by the stable customer base offered to operators. As for outlook, we expect ADR to return to trend downwards in 2025, as SGD remains strong against neighboring currency. With its balanced mid to upper scale hotel offering, Far East aims to attract more budget-conscious Chinese tourism, who previously stayed in luxury hotels. Due to the hotel's vintage, the hotel offered by Far East, it offers more spacious accommodation compared to the newer hotel in the similar price range, which is highly favored by Chinese guests. And although Far East has trying to sustain its rate at the current level, they observe that corporate demands are getting cautious with softer booking activity compared to last year. Although 2025 appears less eventful, but there is several attraction opening up, such as the Minion Land and also Super Nintendo World at USS, and also expanded Sea Aquarium, which is anticipated to draw family groups. We expect positive RevPAR growth to extend till fourth quarter 2024, with potential softening in 2025 due to the targeted customer base is in mid-income tiers, which tend to be more price sensitive compared to those staying in luxury segment. Far East also expect its year-end valuation to hold steady, with potential for upward revaluation due to operational excellence. So we maintain a buy recommendation with unchanged DDM back target price of $0.75. Far East Hospitality Trust is trading at FY24 dividend yield of 6.5%, and also pretty attractive valuation of 0.7 times price to NAV. We believe the DPU FY24 DPU will be at least on par with the 2023 level, boosted by the resilient ADR and also its capital top-up from divestment of Central Square, which left 5.8 million to be distributed for the next 2 quarters. Yeah, that's all for me. I'll hand over to Din for technical part. Thank you.
Thanks, Wilmar. I'll do the technicals. So first out, looking at S&P 500's chart, last week there was a bit of weakness that set in from Thursday, as we saw a breakdown of this upward support line, as well as the confluence of the previous range consolidation resistance breakout level at 5,767. So with that, we could potentially see some further weakness ahead for this week, with immediate resistance at 5,770 to 5,825 area, and support at 5,635 to 5,700 area. Now then, next up for ETF monthly for October, we titled it Bitcoin and Gold to Extend Bullish Momentum. So first up, to review the performance of the respective ETFs in October, most of the ETFs actually pulled back, with the exception of gold and Bitcoin, which was up 4.3% and 9.8% respectively. Yeah. So as for their current trends, S&P 500 is in the uptrend, gold is in the uptrend, and Singapore equities are in the uptrend as well. US Treasury bonds, Bitcoin, and Hang Seng Index are in the range consolidation, while oil is in a downtrend. In terms of outlook for November, we could see some rebound in terms of for US Treasury bonds. Gold and Bitcoin are expected to extend their bullish momentum in this month. As for the rest of the asset classes, we are likely to see some sideways consolidation. So first, looking at the S&P 500 ETF VOO. Currently we saw a little bit of a pullback in the second half of October, so that we could potentially see a retest of the $517 horizontal resistance breakout and there some sideways consolidation thereafter. For the US Treasury Bond ETF IEF, we are seeing a bit of a pullback towards previous resistance close to about $93, $94. Also nearing an upper support line as well. So that potentially could see some rebound this month. For the Gold Mini Shares Trust, GLDM, we're still seeing very strong momentum with price trading above the rising wedge resistance. So potentially we could still see this bullish momentum extend into November. For the oil and gas exploration and production ETF XOP, price is still consolidating within a descending wedge. Key support at 125 likely to hold, but resistance still around 137, above 137. So we could potentially still see some sideways consolidation for this one. For the Bitcoin strategy ETF BITO, some positive was that price actually broke out of a downtrend channel since February or March this year. So with that we expect price to actually remain above this, hold this breakout and actually potentially retest the $22 high earlier this year. The next one for Singapore Equities ETF ES3, just a bit of sideways consolidation as price just trading sideways since start of September. But we expect price to still hold above $3.50 resistance. So maybe some consolidation in November. As for the Hang Seng Index ETF, just a bit of sideways after a pullback and price ran above $80. So we are still expecting some sort of sideways consolidation for now. Yeah, then for the Thai SDR money for October, we titled it Delta Electronics to extend its bullish momentum. So for October, the performance of the SDRs were actually quite mixed. The top loser was Siam Cement, which was down 12.8%. Top gainers were Gulf Energy, which was up 16.6%, and Delta Electronics, which surged 28.9%. In terms of their current trends, Gulf Energy, Capitaland Bank, Advanced Info Service, and Delta Electronics are currently in an uptrend. Airports of Thailand, CPO, are in a range consolidation, while PET and Siam Cement are in a downtrend. For outlook for November, we expect Delta Electronics to extend its bullish momentum and some possible slight rebound for PET. As for Airports of Thailand, CPO, and Siam Cement, we are likely to see some pullback in their prices. And Gulf Energy, Capitaland Bank, and Advanced Info Service could see some range consolidation. So first up, looking at Airports of Thailand, it's some pullback from the downtrend resistance line. So I think we could still see some weakness in price to actually retest the $59 to $60 area before price find some support here. Yeah. And for CPO, price is just consolidating sideways since September. Yeah, but still some resistance above about 67 there. So I think we could still see maybe a bit of a pullback to retest the previous resistance breakout level close to $60 to $61. As for PET, yeah, price actually pulled back towards a previous swing low support, close to $122, $123 in March this year. So I think we could see some slight rebound. But overall, the counter is still in a downtrend. Then for Gulf Energy price, seeing strong momentum, but starting to consolidate a bit sideways with some resistance at $68 to $71. So I think for November, we could still see the stock consolidate a while to consolidate its recent gains. Then for Capitaland Bank, price is doing a bit of a consolidation pullback within the bullish flag. So I think we could still see maybe some sideways price movement with some support level at $139 to $140 per bag. For Siam Cement, overall price action is still weak. Overall trading within a descending broadening wedge. But since price broke down below $225, we still seeing some weakness for the past few weeks. So I think with that, potentially we could see some further downside to retest a swing low close to $196. For advanced info service, quite overall still uptrend, but seeing a bit of a sideways starting to take shape. With price retesting a breakout level around $270. So I think with that, we could likely see some continued sideways into November. And last but not least, for Delta Electronics, very strong momentum in October. Price actually broke above the triple top resistance around $110. So I think with that, we could still see a price hit higher towards $145 to $150, which is about 4 to 5% upside from current price. So that's all from me. I'll hand over time to Paul to give an update on Oiltek. Thanks.
Yeah, thanks, Ian. I'll just move on to Oiltek. Just a short update. Dancing in Latin America because they're getting orders from that part of the world. Next slide. Okay, so they announced a 45 million contract in Latin America. So in total, that brings their total order book to about 200. To this year about 200 million, and the total order books outstanding about 400. If you look on the table on the left, we still think they can get more contracts in the remaining part of the year. So we're still looking at maybe exiting the year at about 500 million. So the highlights is that they have been compounding their order books of 50% from 2019 to 23. And so far, the new orders is 200, slightly still below the 300 plus that they secured the record in 2023. So hopefully they can get more orders in the rest of the year. But this time round, the opportunity they are enjoying is opportunity in Latin America. They didn't mention which country, but we think it's likely Colombia, because Colombia is the fourth largest producer of palm oil. The contract is actually to do a refining of palm oil. So what happened is that after the lull in pandemic, production in Colombia has returned. I think it has grown almost 22% the last 3 years. So once production increases, they need downstream facilities to refine all this crude oil production. So as a result of this, I think they are enjoying a string of contracts out of Latin America or Colombia. So no change our forecast and maintain a buy. Next slide. I'll move on to Sheng Siong's results. So Sheng Siong announced their third quarter results. The highlight is that this time around they are back to growth. I think more stores and there was margin expansion. Next slide. If you look at the results was revenue was within expectations, but actually the profit beat our numbers about probably 4 or 5 percentage points. The positive was gross margins continue to surprise us and probably surprise the market. We always thought that no gross margins will stabilize, but they managed to grow their gross margins to 31.3. Mainly fresh food. So fresh food means seafood, can be fruits, vegetables, where they have the best margins, and they have a higher contribution of fresh food, and then the margins on fresh food itself actually expanded. But they mentioned some things like there were more promotions on prawns and so forth. So I guess if you want to shop for more prawns there. And the other thing is the negative is the lackluster same-store sales. So if you look at revenue, revenue grew 5 percentage points. So they do a good performance attribution. They will tell you like 3 percentage points come from new stores. So new stores means stores open less than 2 years. And then same-store sales grew, which is the organic growth you can assume is about 1.5, which isn't strong if you're considering that the GST rose by 1%. So it's virtually flat for same-store sales. So this is a bit of a lackluster for us. And that was the negative for us. That China part, they have 6 new stores, so that contributes about 0.3 percentage points to growth. We raised our earnings by 5%. Our accumulation is maintained, and we also increased our target price in line with the forecast change. So as we move forward, the outlook for Sheng Siong will be better because they are opening at least 5 stores this year, and probably one more likely because of the cold storage that they acquired in Toa Payoh. But so this will be almost triple. So the last 3 years they only open on average 2 stores per year, but this time around you're opening about 5 to 6. So new stores alone can contribute around 6 percentage points of revenue growth next year. So at least the growth is accelerating. But again, Sheng Siong, you're not talking about high double digit, you're talking about mid at least a high single digit kind of growth rate for them. Where new stores together with higher margin, gross margin expansion will provide the earnings growth for them. Next slide. So I'll move on to our usual weekly update. Not much news in Singapore, but we had some RevPAR numbers. So RevPAR, for those who don't know, is basically revenue per available room. So it's virtually the revenue that the hotels in Singapore are enjoying, because you were looking at the average room rate times occupancy. So it's basically flat, but in a way it's positive because the last 2 months in July and June, it was actually down 5%. So the growth rate is not as good as after that so-called revenge spending period, but at least it's still stable. Room rates was down and occupancy just went up a little bit. For exports, I think in line with our expectations, we do think exports were slow. So we always look at Korea and Taiwan exports. So that is the pace is slowing down. We think because of the stocking up in the US in the third quarter. So our own expectations is that there'll be slower export growth. In the US, there was two main macro news. So the first is the core PCE inflation, which is what the Fed always targets 2%. So the good news is that it is actually trending in line. It's still coming down within expectations. But the key thing is that inflation is still trending down. The Fed's favorite gauge, because there's another number, the usual inflation, but this is PCE inflation. So in terms of jobs, of course, it was a horrendous number, 12,000, but it was impacted by the 2 hurricanes in the US. Expectations were 100,000. It came out at 12, and also there was a Boeing strike that affected the 44,000. So what happens is that when there's a hurricane and Boeing's, the participation rate, because this is ultimately a survey by businesses, and that was one of the lowest in more than 30 years because of hurricane. Not many companies could participate in the survey. So of course, the additional payrolls that they got was very low. But the household survey, where the unemployment was stable, so 4.1. So it's a bit of a mixed news because they actually revised downwards their prior years' earnings. But in general, you can just think of payrolls in the US is just stable, not accelerating or decelerating. Next slide. So we issued our usual Singapore monthly, and our Singapore monthly was focused more on the upcoming elections on 5th November. So far, Trump leads the election. In terms of the betting averages, that means if you put a bet, it's still leading. We'll show you a chart later. So the path to victory for Trump will be to win the Sun Belt states. You're talking about these 3 states: North Carolina, Georgia, Arizona, versus the Blue Wall states. If Harris intends to win, she has to try to nail down these states, which is Pennsylvania, Michigan. Again, everybody tries to hit the 270 electoral votes. So far, based on the latest polls, but everything is within the margin error, it does show that Trump is leading in the so-called Sun Belt states. And also, Harris is also gaining some momentum. So the key will be Pennsylvania. I mean, if I have to take a guess, so this will be the decider, because if Harris wins Michigan and Wisconsin, then Pennsylvania will be the decider in terms of like who wins the electoral votes. So if you assume what's the implication of a Trump victory? Firstly, some of his policies include mass deportations. So the estimates are from 1.8 to even 3 million of illegal immigrants which he wants to deport. And if that happens, the study shows that there will be, of course, a supply shock or inflation shock similar to what happened in the pandemic. Suddenly you don't have workers. I think the worst will be agriculture sector. The second impact will be he intends to implement import tariffs on all countries, China especially 60%. So this will be negative because import tariffs is going to pull down emerging market currencies, EM currencies. Worst hit will be China and Mexico because they are exporters. And also, usually when currencies are down, you will also affect equities because the flows will go back into the US. So it will be positive for US dollar, but negative for EM. And usually the equities will follow these flows. The third impact of a Trump victory will be higher fiscal spending, because both also have extra fiscal spending, but I think again, study shows that Trump will be higher, mainly because of he have more aggressive tax cuts on overtime pay and so forth. So this higher fiscal spending will only raise bond yields and also raise inflation expectations out of the US. So that's why we have seen, even though the Fed has cut rates, actually interest rates are actually, the bond yields actually increase in view of, I guess, worries of a stronger fiscal spending and of course a higher inflation in the US. So in conclusion, if we do get a steeper bond yield, so steeper bond yield means the short term, let's say the short term rates, the Fed funds rate is I don't know 4%, but bond yields could climb to 5 or 5+. So in a way, a steeper bond yield actually positive for banks because of gapping opportunities. So what happens is that banks can collect short-term deposits, your current account or whatever at a lower rate, and then gap it up. That means put it into longer duration assets, and then they can earn a better spread from it if the yield curve kind of steepens. If we do get so Harry's win, we could actually see interest rates gap down. That's what we mean by gap down in bond yields. And this will be positive for REITs because interest rates will just gap down because on expectations that there'll be less inflation and fiscal pressure, especially if we get a divided government, because then there will be less fiscal spending if Harris wins. The other thing to note, there's a lot of news to watch, but the other thing to note is the National People's Congress by China. So there are probably going to be details of a fiscal stimulus. Again, it's all speculation, but speculation is that the Chinese government will spend 2 trillion on fiscal spending, and they will also swap some of the local government bonds with the central government. So this will free up the finances for local government, which is extremely tight right now. So the key events, we have the NPC, National People's Congress in China, that will determine the stimulus. Then after that, you have the US presidential elections. Then after you have all the 3 banks announcing results, and then you have a Federal Reserve rate decision, which we think the Fed will be in line with consensus of a 25 basis points cut. At the same time, we also have webinars if you want to attend. We have AIMS, Propnex, Manulife for this week. Thanks. Move on to the next slide. So this just shows the number, although RevPAR, which is the red line, is actually slowing down, but no, it's still rising. So the growth rate won't be as strong, but no, we're not expecting like a major collapse in 2025. It will just be softer and probably not much growth. Then this is just to show the exports. Next slide. So this is the one on the left is the US betting average. So it shows that Trump is leading in terms of the betting markets. The one on the left is the poll number. So the one I try and make it as great as I can. But if you look at North Carolina, Georgia, Arizona, you can see that Trump is taking the lead. So unlikely there'll be any surprises here. Harris at the same time for the blue wall states, she's actually taking some momentum, but Pennsylvania is undecided, so that could actually be the decider for the electoral votes. But again, this is just my guess. Next slide. Yeah, if you move on to the one on the left is just the inflation. The key one is the red line, which compared to the green line. So you notice that inflation is still coming off very sharply, but we think that when we come to November, December, we think inflation might be slightly higher than expected because last year the base effect. So, but come to early 2025, we think inflation could slide down much sharper because there's a bit of base effect because last year was extremely weak. So we're not sure whether there could be some bump in inflation for the November and December. If you kind of extrapolate the current trends. This is just the labor market. It shows that labor market unemployment is stable, coming down, but the vacancies to unemployment, that means the amount of jobs available, is actually coming down much lower than pre-pandemic. So in a way, we don't think labor market in the US is as robust as expected. It's mainly government-led jobs. Next slide. I'll move on to later on. One of the top performers for last month, we'll talk about it later, but it was Hong Kong Land and also DFI. So when we look at the Hong Kong retail sales, we thought retail sales in Singapore was bad, but actually Hong Kong was worse. It's down 6%. It's a 7-month of decline if you look at the red line. And then office is in Hong Kong is also coming down, the office rents. So because these two stocks were up, we just want to show that actually the environment is still challenging for Hong Kong. We'll discuss it later since Hong Kong was a top performer. Next slide. Move on to our model portfolio. So this is a model portfolio. The ones that saw the sold down was OUE REIT and also Capitaland investment. So the property and the REITs was a drag. The one that put this up was SETS 9.1. The one on the right is just again, all this is just for illustration how we fare compared to the index or the S-Sync index. Thanks. Next slide. I'll move on to the, this is just by sector. This is the way we kind of segregate the sector. It may not be similar with everyone, but you'll notice most sectors were down except shipping, where inside shipping is Seatrium and Zhejiang. Property was also surprisingly higher. But and the finance, which is banks, was stable. So the stable banks actually held up the index. On the right is just a snapshot of some of the mid caps, small caps, and the large caps names. The bottom is the index. We cannot use STI because otherwise they'll charge us if we use STI. Although the market really not very many people bother about STI, but they still want to charge us. So at the bottom here is just the main large index gainers. Yeah. Next slide. So these are just by the asset classes. If you notice, actually it was a tough month. Most assets were down. If you look, most assets were down, and REITs was the worst hit. These are all in US dollar terms. And gold was the best performing asset class, as was mentioned by Zain earlier. Next slide. Again, this is by the various Asian markets in local currency terms. Again, almost every market was down. One that was only up was Japan and Taiwan. Yeah, this is just for your reference. Next slide. Just one last one. We have Phillip on ground. So we had Wilmar had a third quarter analyst briefing. So Wilmar is a palm oil refining plantation in soybean crushing in China and edible oil consumer packs in China. So the earnings was down mainly because of sugar. And also lower consumer margins. So so for sugar, that was the biggest reason. They don't separate the earnings. They just say that this was the one that caused the weaker earnings. So last year, Wilmar did very well because of sugar, but sugar prices have come off. And also they have lower milling margins. So milling margins is like the refining margin, so-called, but that does well because that is a percentage of sugar price. And in Australia, there was a strike, and the strike actually affected their crushing ability to crush in the fourth quarter. And also they had to pay higher salary. So they said that this will impact their fourth quarter numbers. Refining is still doing well because of the lower excise duties. In terms of palm oil, although palm oil is at an unusual premium to soybean, they say that palm oil will still be healthy because although demand in China and India has started to be impacted, but because biodiesel demand remains strong, so Indonesia is pushing from B35 to B40 biodiesel because Indonesia intends to be self-sufficient in energy. So that is actually sprouting up a lot of demand for palm oil within Indonesia itself. So the comment is that fourth quarter, they're looking more cautious because they are, I think, just worried about China sentiment, the consumer sentiment, and it might worsen if there's worsening geopolitics. I think it was referring to the tariff hike. So if there's a 60% tariff hike, it could make sentiment in China even worse because exports are going to be impacted even more severely. And the sugar weakness will also hit in the fourth quarter. So they're a bit more cautious in the fourth quarter. Okay, I think that's it from me. Okay, thanks. You can move on to Q&A.
Hey, thanks, Paul. Yeah. I will try to take the Google one. Hold on, where is it? Yeah, so I think there's two questions asking the same thing, essentially, about the antitrust case as well, how much of a concern it is, and also, if they are charged, what would the charge be, and whether or not they will be forced to break up into different companies, and so how will it affect the share price, and especially for investors, right? So firstly, for Google, it's not much concern in the near term. If you look at it, it will take quite a while for them to decide on how are they going to change it, because it's such a big sort of thing, right? It's so huge that even the regulators will have they have to call on the experts as well to find out how can they make it better and not just give them the fines. So there will probably just be fines, right? There'll definitely be fines, and this would not really impact their business or their PATMI as much. But I think the more important thing is regulations wise, what are they going to do in the future? So if they are forced to split up the businesses, such as their advertising or their cloud, or maybe, split up their back end and front end, then it could be a case where there would be more value separately rather than, lumped up together. And also, it could also allow them to maybe have to innovate more. I think now they're really they are pushing much towards their AI side, trying to see if that can be a factor where people will lean more into Google. So, but then again, Google being such a big company and everyone uses Google, it will be quite hard for the regulators to also find a perfect scenario where they can stop that monopoly. I think that's the biggest issue, right? Is the monopoly of Google, them paying Apple every month, every year, billions of dollars just to put their search engine as the default choice. Or I think even in their Chrome browser also, Google's the default search engine. So there might be things where the regulators will probably say, okay, you will not be able to pay them to make it the default. So that will see whether or not it really comes into effect, and how much it will affect Google, and if consumers will actually move away from Google, because that's like the main search engine that almost everyone uses now. Hope that answers the question. Okay, there's one more about the then also just to follow up also, it could also slightly benefit Microsoft with their Bing search engine and the other competitors that are coming in. Yeah, but then again, okay, let me move to the one on the finance side. I think someone asked a few questions about iFast. Okay. Yeah, asking whether, why is there so much volatility, and, the results were good, but there was a recent sell-off. Is it the PE is too high or something else? I think the PE being high is one of the factors, right? It's a big part actually that their PE is a bit above I think about 40x versus they are not really competitors but their peers, right? It's just around 20 to 30 times. Okay, so that's probably one of the reasons why. But I think the more importantly, if you look at the fundamentals, right? They are, I mentioned earlier last week during my Phillip on the ground on iFast, that their growth, while strong, you can see, they're like reporting, surge in revenue, surge in net income, right? 80, 100% count, 90% count of growth. But what we are seeing, the trend is that this acceleration has actually slowed. Previously it was like 150%, 200% kind of growth. But now we are seeing, back to like double digits, 80, 90% growth. So there's something that's stopping this continuous acceleration. Acceleration is declining. It's still accelerating, but it's declining. And the main factor is that, they are catching up with the low that they had last year, right? So, they didn't do well last year, which is why, if you see the last few quarters, why they had this huge growth, right? But what's happening now is that they're finally catching up with what the growth that they had last year. So we'll continue to see this decline in acceleration. And I think the main thing that's sort of why there was so much hype about iFast previously was because of the e-pension, right? This was a huge boost to their revenue and to their bottom line. But they haven't changed the guidance since February of this year. So in close to 9 months, they haven't changed the guidance. They said that it'll come in slightly higher. But I think that the e-pension revenue boost as well as earnings boost has really been priced in. And they also haven't really proven the global bank system. They are still loss-making. I guess they have to be loss-making in order to take on the deposits and to continue growing, right? But they haven't really shown that, okay, this is our way, how we're going to make profitability from it. I did ask during their results, like if there is majority of the clients are from the banking side, the global bank side, is it just existing customers joining the platform because their salespeople are pushing it, ask them to join? But surprisingly, it's no. So it's a lot of new customers, and then they are actually cross-selling these customers to join their iFast wealth management platform. So that's a good indicator of how they can become profitable with the global bank. But they don't intend to from what I could hear, at least they don't intend to open the global bank wealth management platform. So they're just going to have their own iFAST wealth management platform, and then the global bank is just literally just a bank. Yep. So that could be a way to profitability for the banking side. And I think if they can prove that, we could possibly see some positive or improvements in the share price. But currently, with the e-pension already priced in, and also their AUA growth already sort of being quite stable and steady for the last couple of quarters, and their global banks still loss making. It's just really a lot of the same news that we have seen since the start of the year. Yep. So I think there needs to be some change as to where they are going to be heading towards. I think there's one more here. Yeah, okay. So it's just the main one about the banks, right? I think there are a few questions here about the banks. I'll just lump it all together. Basically asking, what is the view on the banks? How do we see the third quarter results as well as the full year FY24 results? So for the next quarter, the third quarter, for the banks, we'll probably see net interest income decline slightly. I think it'll be low single digit sort of decline, year-on-year decline, right? NIMs will also be slightly compressed. I think we'll see their margins drop by a few basis points across the board. So it'll be quite relatively similar. But the good thing for the banks is that they're now putting a lot of their excess deposits, right, into longer term interest earning assets. And they are able to sort of protect their NIMs as well as their net interest income, which is why we only expect a few basis points dropped in their NIMs as well as only a low single digit decline in their net interest income. But I think what will be the growth driver for the banks will be their fee income. Most notably, it would be the wealth management side, right? Their brokerage and trading has also been performing quite well, but that only makes up a smaller portion of. If you look at the whole big picture, right, trading brokerage only makes up a small portion of their revenue, right? So wealth management will be the big kicker for all the banks. This will be coming in, with the higher AUM. Customers are now putting in money into the bank's wealth management side instead of just throwing it into fixed deposits. So this investor sentiment shift from low risk investments, right, but relatively good yields a year ago when they were getting 4-5%. Now they have to shift away from that because now all these low risk investments are getting them maybe only 3% or 2 to 3% at best, right? So now they are shifting towards the wealth management side, and the banks are also cross-selling are trying to sell these investments quite strongly. They are pumping, like OCBC, they are trying to hire more RMs to be able to push their wealth management segment. So I think all the banks are focusing very much so on this fee income segment now instead of trying to sell loans or trying to push for deposits. So that will be what will be the growth driver for the banks. Provisions wise, it's looking to be rather flat. The credit costs basis points I think will be relatively similar quarter on quarter, and the full year I think we will be still looking within the guidance of what the banks have given. So I don't think that will be so much of a positive or negative for the bank. Whereas the last line item we look at is the OPEX. For OPEX, the banks have not been. I think they have been trying to control their OPEX quite a bit because they realize that there's a bit of a slowdown in their net interest income, so they can't really push as hard on trying to grow their technology or to hire as many people. Yeah, so I think the OPEX line will also be rather flat if you look at it for the next 2 quarters at least. So I hope overall we'll still see good growth. Definitely not as good as the year before or at the start of the year, but we'll still see positive growth for the banks, and hopefully, most importantly, I think for the investors, which they're looking at when you invest in Singapore banks, is the dividends, right? So with that, if the UOB and OCBC, right, they keep up their 50% dividend payout ratio, then we should see a net increase in the dividends being paid out. As for DBS, hopefully they just paused for 1 quarter because of the announcement of the new CEO. So that was the reason why they gave that they didn't want to increase dividends, right? So if they can recover from that 1 quarter, and then if it kicks in finally in the third and then finally the 4th quarter, we could possibly see even more dividends coming in for DBS. I think to wrap up, after speaking so long, sorry, it took some time. I think our topic would be UOB. If you saw Paul's presentation on the Absolute 10 portfolio, UOB is there. UOB is our topic mainly due to they have this huge sum. There are three factors. Okay, the first one being that they have a huge sum of the deposits that are going to be repriced, right? You know, if you are familiar with the local banks, you know that UOB was very aggressive in giving out high interest rates for both their fixed deposits and their flagship current account, which is their one account, right? As compared to the other two local banks. So what they have done is that now they are lowering their fixed deposit interest rates. You can see it if you go and just click into online, you search what are the bank's fixed deposits, right? UOB, I think, is one of the lowest now, right? They're realizing that they have too much excess deposits, you know, their cost of funds are rising. So all these are going to reprice soon. And also their current account, savings accounts, cost of funds will also lower because they are I think the first bank to lower their flagship one account interest rates. But yet it's still higher than the other two banks. So that says a lot how high it was previously. So that's another benefit we can see from the cost of funds, that it will just drop compared to the other two who can't really change much because they were not giving as high rates. Secondly, is that they are shifting towards a very heavily towards the fee income segment, right? They are pushing and trying to see if they can, you know, move from maybe a 30% kind of overall makeup of the revenue now to 35% by I think 2026. So now they're pushing towards fee income. And what is positive is that their Citibank acquisitions has accelerated this push or this growth by around 3 to 5 years. So they're able to bank on this Citibank assets to be able to concentrate on the new mission, I think the new growth driver, which will be fee income. And last but not least, they're also realizing that Singapore is a bit too saturated, the market, the growth is slowing down. So they are pushing more towards the ASEAN 4. That's what they call it, the ASEAN 4. That would be where they have the Citibank assets, where they acquire the Citibank assets. That's like Malaysia, Thailand, Vietnam, and Indonesia. Yeah. So those 4 countries, they see more growth there because those are developing countries. So those are the 3 factors why we feel that UOB is the topic and there's more room for them to grow, basically. Okay, yeah, sorry, spoke a bit long. There's one on credit bureau. Let me get back to you on that. Yeah, I can drop you an email on the credit bureau. Let me go and check. Yeah, I think that's all I have. Let me double check. Someone asked to put up the UOB slide, please. I'm not sure what UOB slide you're talking about. I think are you referring to the Absolute 10 portfolio? Maybe you can flash that, Zin, if you could put that up for maybe a minute or so. Yeah. 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 Okay. So we do have an accumulate call rating as well as a target price of $34.90 for UOB. Okay, that's all I have for me. Let me hand it over to the rest of my colleagues. Thanks.
Hi. Thanks, Glenn. Okay, thanks for your questions. I'll take on some first feedback is on WeHer. Can get WeHer to do a webinar, please? Yeah, we are in the early phase of talking to them, so I think with subsequent meetings we will try to go to a step. Yeah, thanks for your feedback. One question on Ascott is how did Ascott revenue surprise come about? Is it because there was no quarterly results release? There's actually a quarterly results release, but I see where you're coming from because I also saw that on their corporate website there wasn't any results posted there. So if you want to read their quarterly results release, you can go to SGX, search for SGX announcements, and then after that you search for Ascott Global, and then you can see their quarterly results release there. So to answer your first part of your question, how did the revenue surprise come about? There's a very steep drop in revenue for year on year for the third quarter from 283 million to 166 million, which is a 41% drop in revenue for this quarter's release. And that also explains why their share price actually dropped a lot, because this steep drop in revenue actually caused their net profit to drop by 55% year on year, from 30 million last year 3Q to 13 million this year 3Q. Yeah, so and this steep decline in revenue is also because they have declining order book trend. As of 1st October this year, they have secured an order book of 142 million. And this 142 million is stated to, most of them is stated for completion until the end of the year, this year itself. Yeah, so we actually don't really cover Aztec. We don't cover Aztec, but my view is that with this declining trend in order book, it is not a very good sign for investors, because this decline in order book will actually mean that their revenue will continue to decline. And when revenue declines, it actually will have a direct impact on the net profit itself. Yeah. Next up, there's a question directed to Paul. I'll leave that to Paul on Aztec. I think there's one more question on Aztec. Most analysts are positive on Aztec. What causes the surprise drop in earnings? Yeah. So the drop in earnings is actually quite a surprise, because from last quarter itself, I remember that revenue only dropped by 4% year on year. But for this quarter itself, it suddenly dropped by 40% year on year. So it is also a surprise to analysts as well. And last quarter, I mean, few weeks back, we actually went to their plant visit, and they showed us their plastic injection capability, which their story was that with this kind of new plastic injection capability, they are able to bring in a wider range of products and order book. But from this quarter earnings itself, we can see that order book hasn't been growing because of this added plastic injection capability. Yeah, so I think after this quarter's earnings, I think many analysts will shift their position. Yeah, but that is just my view. Yeah. Thanks for your question. I'll hand over the time to my colleagues.
Yeah, let me just okay. So for Aztec, the earnings for third quarter was down 55%. The order book is also down 55% for the same period last year. So the same period last year, their order book was 300. Now it's also 144 million. They are telling investors that it's because US slowed down, but I don't think US slowed down until 55% drop. So my only my guess is that for Aztec, their biggest customer is Blink, and Blink is partly owned by Amazon. But the risk for them is that they are very reliant on one single customer, and this particular customer only sources all their production from Aztec. So we think there's possibility that they might have been a second source, or even if it doesn't, there's going to be that risk. So that we think could be the more likely reason why there's such a big drop, because I don't think retail sales in the US dropped only 55%. And the third thing to take note of is that they always like to privatize companies. Those who follow Aztec, they've done a privatization before, so you can just draw your own lines. Yeah. But I think what they're guiding investors is that the new products will help stable earnings. But again, fourth quarter will also expect another horrendous quarter for them. I think you just see the order book. That means they're going to the fourth quarter with the order book that's down 50%. So you can assume it will be another bad quarter for them. But my biggest worry is that they're no longer the single source for their major customer, which shouldn't be. I'm not sure which producer will only use one single contract manufacturer and take all the risks. And also you got competition, right? Competition will just come in and try and take. So that was the big risk. So there was one question: is it like another AEM? In terms of customer concentration risk, that is the issue for them, I guess. Not to draw similarities. One is contract manufacturer and AEM is semiconductor. Yeah, but at least for AEM part, to give them the benefit, AEM is building their own brand name. They're building their own branded semiconductor equipment, which is it's incredibly difficult to do in such a such a concentrated high barrier industry, which they have, I mean, they're making inroads, I mean, to be fair. Yeah, you might want to answer the AMD one. Okay, never mind. Let's move on. Helena and the rest, yeah.
Yeah.
Or Darren.
Yeah, let me take on some first in the meantime. There's a question on Manulife FA, Manulife REIT FA and TA. Of course, the TA portion I'll leave it to Zane. But the FA portion, Manulife now, the main issue now is to reduce their gearing. Now it's still about 56-ish%. So, or in fact, they'll be releasing their third quarter results this week, and we'll also be hosting them on Thursday for webinar. So please feel free to join. But for me now, my my analysis for Manulife is that they need to divest their properties definitely to lower their gearing, and it is part of the recapitalization plan. So far they've already divested one, and that one, if I remember correctly, was about 30% discount to the book value. So going forward, I believe we will likely see similar discounts because the transactions market still not that strong, and the funding from banks are still not there. Basically, the banks are not lending to fund any US commercial real estate. So any purchases are fully equity or private equities, which was the case for both Prime US REIT and Manulife's recent divestment. So that is for the recapitalization part. But for the leases and occupancy, I think will still remain around 80% for Manulife because there are some weak sub-markets. So yeah, expecting relatively flattish occupancy quarter on quarter for them. Yeah, so we have more updates Wednesday when they release their results, and please feel free to join their Thursday as we host them for corporate insights webinar. Shifting our focus on Class Life Funan recent investment, what do you see are the pros and cons of this, especially taking into account the weakening SG demand? Yeah, so for this acquisition, it was done at an EBITDA yield of 4.7%, first of all. So that is definitely a pro. And that is 4.7% in comparison to a lot of other hospitality assets in Singapore, where we are seeing a 3.5 to maybe 4-ish% cap rate. So at 4.7% EBITDA yield, it's relatively attractive. This acquisition is also DPS distribution accretive of 1.5% on a pro forma basis. And basically they do not really need to raise funds, or rather the funding plan is to use the 13-pound Sophia Singapore that they divested earlier the year. So they divested it at a 3.2% exit yield, and they're investing in this Life Funan at a 4.7%. So it's relatively attractive. So that is the some of the pros. But on a operational wise, Life Funan is also performing relatively better than other of their than some of the comparable properties in its sub-market. But the growth going forward will likely slow in Singapore, like we mentioned in the earlier presentation, where we've seen some of the basically the softening demand, the ADRs are likely to be slightly flattish or even weak, or even come down slightly. But overall RevPAR, we still see a little bit of growth from improvement in occupancy. So going forward, we think the contribution from Life, the growth in rental income contribution might not be that high, but on a base case, it's still decent at a 4.7% yield. Yeah, and Life is basically a flex hybrid hotel in residence model where it's more of a social living experience. So it caters to both short stay and long stay guests. And Life, as you know, Funan is very near City Hall MRT with direct access through an underpass, and yeah, it's well located. So it is a good asset. Yeah. And the cons is so I mentioned some pros, and the biggest con I'll think is just the fact that the income contribution from Life might grow slightly or flattish this year and next year going forward. And we do not expect that much growth from the flattening of RevPAR. Yeah, so that's a con, but on a base case, it's really 4.7% EBITDA yield, so it's okay. in comparison to, like I mentioned, a 3.5% average cap rate for Singapore hospitality assets. Any views on the recent sell-down of Capitaland and Ascott? Yeah, so I think that is more of an market sell down. Like we saw the 10-year yield, like Paul mentioned, the yield really spiked, so that really hurt some REITs. So a lot of the REITs we saw a big sell down. Yeah, but for Capitaland and Ascott, we saw in their third quarter business update, no financials were provided. Just that their occupancy dipped slightly due to some leases expiring, but we saw some very high rental reversions as well. In the teens rental reversions. So that is similar to there's another question on Mapletree Industrial Capital DC results. Yeah, so Mapletree Industrial, Ascendas, Capital DC, both all three also reported some strong positive rental reversions. Mapletree Industrial and Ascendas, they have some leases that are expiring, so occupancy might be hit and there might be some downtime, so occupancy might remain around the low 90%. Capital DC REIT's occupancy is much higher. If I remember correctly, it's 98%. And Capital DC REIT's Singapore's data center co-location rental reversions were exceptionally strong. So it's the second consecutive quarter of 40% rental reversions. So we think that this can be sustained. But this 40% only for Singapore. The other sub-markets we think likely be in the single digit rental reversion range. Yeah, so yeah, we don't really cover Mapletree and Ascott, so I can't really comment on like the preference and fundamentals. Yeah, but for Capital DC, we currently have a neutral call because the share price it rose quite a bit. Yeah, and it really hit our target price. Yeah, that's all from your hand. Over to my colleagues. Thanks.
Thank you, Darren. So let me take on some questions. So first of all, for PayPal, what is the rationale where it is downgraded, but target price is up against previous target price? So basically, we downgraded the PayPal stock from buy to accumulate mainly because of the recent share price gains. So the stock was already up about 25% over the last 3 months. And based on our methodology, wherein we have wherein the expected stock returns are between 5 to 20% range, we have an accumulate recommendation, and as a result, based on this methodology, we downgraded the stock to accumulate from buy. And we increased the target price from $80 to $90 mainly because our valuation is based on DCF valuation, and as a result, since we have increased our earnings forecast or adjusted PATMI by about 5%, for the full year 2024, our target price increased from $80 to $90. Hope that helps. And a second question, has Microsoft managed to monetize AI investments? So basically the short answer would be yes. So last week, Microsoft, it had reported that on an annual basis, the AI monetization revenue, for the first time, it highlighted that the in dollar terms, the AI monetization it generated about 10 billion US dollars for the on an annual basis. So and this revenue came from AI revenue comes from its Azure AI services as well as its Copilot service, which are integrated across its Windows as well as Office 365 software. So, we believe that this is still in the early stage, mainly because it's still contributes about just 3 or 4% of its total annual revenue, which is about 300 billion US dollars approximately. So we believe that monetization has started, but it's still in the early stages. So hope that helps. Would pass it on to the rest of my colleagues.
Thank you, Ambrish. I'll take some of the questions. Would you prefer to invest in ES3 or G3B, who has consistently higher dividend? So these two are the STI ETFs. The ES3, the SPDR, they're funded earlier, so they have a bigger fund size. And in terms of the expense ratio, both are actually the same. So if you were just to look at the dividend, actually Nikko AM, they pay slightly higher even though not that much difference, like 4.2% compared to 4.0%. So if you were to focus on dividend, I would say invest in Nico, that would be better. I think both are semi-annual dividend, but the dividend payout timing is a little bit different. So if you matters when the dividend was paid out, I think these two are 1 month apart. So SPDR, they actually pay the dividend 1 month after Nico. Yeah, so that's on logic, but these two are pretty much very, very close to each other. I hope that answers your question. Another one I saw is can we expect better result in the future for Apple since iPhone 16 demand was greater than 15 from the results? Yes, definitely. So that's the story that we'll be having for Apple. Even though iPhone 16 demand is not greater than 15, we still expect better result for them in the future. The reason we think so is because Apple Intelligence is going to be fully rolled out in 2025 and 2026, and we think that's going to be a game changer for Apple. Several reasons. One is because we do think that the software update, the Smart Siri, is quite a game changer. It might have the potential to revolutionize the way people use phone. So people definitely there's going to be a lot of people who try to upgrade to the newest device in order to use the new features. Second reason is iPhone performance has actually been really flat for a very long time. So their most recent spike was in 2021. That is 3 years ago. So that means a lot of people using the iPhone right now, they haven't been updating their phone for 3 years. So together with the Apple Intelligence rollout, we do expect these people will actually consider changing their device into a newer device. So all these combined together, we do expect an upgrade cycle. In fact, we don't expect it to be so soon because the rollout is very, very slow. Right now, the beta version rollout is only limited to certain areas. And the beta version, the review have quite mixed. So far, it's not doing that good. So actually, the demand, iPhone 16 demand better than 15 is not how we expected it. So it's actually better than we expected. So I hope that answers your question. I guess I'll pass to Paul.
So sorry, I'll take some questions. One question on AMD. Why did AMD drop so much after results can buy the dip? So the reason why AMD dropped so much is because they guided their fourth quarter revenue to be slightly below what US analysts they are expecting. So they are guiding their fourth quarter revenue to be 7.5 billion, while the analyst expectations are 7.55 billion. So it's just a slight drop, slight difference between their guidance versus analyst expectations. However, this 7.5 billion is still, in my opinion, is still considered quite good because if they actually were to hit this guidance, it will be a 22% year-on-year increase in revenue. Then this also represents a 13% increase for the full year revenue if they were to hit this guidance. And currently our target price is $180 for AMD, and we wouldn't change this target price because there's still a lot of room for growth in terms of their growth segments. So AMD currently, their data center and client segments are growing very quickly because of the growth in demand for AI chips. Whereas the slight differentials in earnings revenue guidance is because of the gaming segment, where there's been a decline in revenue. And this decline is mainly because from COVID, there was a lot of demand in gaming, but then after COVID, this kind of demand slowly died down. Yeah, so hope that answers your question. There's one more question on WeHer. Is WeHer a good buy during the current dip, or was it just hype? We don't cover WeHer currently. But my personal opinion is that over the past few weeks, there has been a lot of hype because there is news that they are going to sell their Australian student accommodations. So I would say over the past few weeks, there's a lot of hype, but I think that the hype has died down significantly. And I personally think that is a good buy because they have quite a lot of catalysts going forward. For example, next year WeHer is going to have their Pioneer Lodge worker accommodations to be operational. So the CEO actually guided that it will start to be operational next year onwards and expected to be fully operational by the end of the year. So this will bring in an additional 11K worker accommodation beds to their current 16K beds. And for context, Centurion, which is the largest worker accommodations, has 32K beds currently. So this increase in capacity for worker accommodations will put WeHer in a good position to take in revenue from worker accommodations. Yeah. So this is one of the key catalysts that we see going forward for WeHer. Yeah. Thanks for your questions. I'll hand over to my colleagues.
Yeah, thanks, Iman. Let me try and answer as many as we can, then we pass it on to Zain by 12:30. Why? Okay, this one. What? How would the results of U.S. presidential election affect the China stocks and SGX stocks, either Trump or Harris? Yeah. So like what I guess like what Wilmar kind of hinted is that if we have a Trump presidency, I think the China stocks will sell down, mainly because of the unpredictability. He's already mentioned he will hit 60% tariffs, but again, you're talking of unpredictability, and my lack of better word, since we cannot sound so political on other candidates. So I think that's going to be priced in. And exports was supposed to be the main growth driver for China. But the curious thing is that it will depend on what the NPC says, whether they will wait for after the election to discuss details of the fiscal stimulus. So you got to watch out for it. I think one scenario is maybe China gets sold down and then there'll be some fiscal measures, aggressive fiscal measures announced. So that could be one scenario. But for Harris, it's basically status quo. The tariffs will still remain, but it will be more measured kind of increase rather than some spike or 60% jump in import tariffs imposed on China. Manulife FA. Okay, this Apple was already answered. Is Genting outgoing results expected to be weak as competitor MBS reported weak results? So we think, my own guess, I think Genting might still announce probably mid or single digit growth, because in the MBS results, the weakness came from junket and also luck factor. But their mass market, which I think Genting has a higher share. Their mass market actually did very well. I think it grew like, if I'm not mistaken, 15 or 20% around there. I don't have the exact number. So it wasn't like a totally washout for MBS results. It was a bit mixed because the mass market did very well. Mass market has better margins, but the junket was just bad. I mean, junket, I think you won't get any more of those whales or Chinese whales coming to Singapore to gamble. Yeah, so I think it will still be fine, I think, Genting results. But again, all these are all X growth, I think, in line with the tourism numbers, I think. Why CSE dropped despite getting orders? Yeah, I looked at the numbers. So even though they got orders, their order book, outstanding order book is basically flat or maybe down 1%. Yeah, so again, getting orders is one thing, but whether most important is the year-on-year growth in the order book. So that is actually like something similar to Aztec that we mentioned, but at least Aztec is down 55%. So for CSE is down about it's virtually flat or down 1%, hardly change. So maybe that's why maybe investors are a bit more worried of the growth outlook for CSE. Prawns in Sheng Siong are indeed cheaper than other supermarkets. Yeah. Actually, I went there and I think the Vietnamese prawns are about $12 a kg. Yeah, but anyway, yeah, you're right. Yeah. Can you explain why Wilmar profit is down 36 yet stock to go down? Yeah, I think there was a lot of downgrades. Actually, the share price actually went down after the results. I don't think it went up. Yeah. And the other thing is, Paul, are the stars for like, yeah, I thought it was aligned for Wilmar because I thought palm oil price up, crushing margins were up. And last year they had a very low base to compare because last year, third quarter, the earnings was down about 70%. So I thought it was a good bet for Wilmar this quarter. I mean, obviously I was wrong. I think the sugar and the strike really worse than expected. I think it'll be more stable coming to the fourth quarter. I mean, hopefully now this can't say stars align anymore for Wilmar. Yeah, but I think it will be better performance from the Indonesian plantation companies because they will have a better directly benefit from the higher palm oil price and also from the lower export duties. Whereas Wilmar, because they've got a lot more refining, and when output is lower, their refining margins are affected. So yeah, that's the other thing. But anyways, a reminder not to say stars align for Wilmar ever. Can update on Olam recent plan to spin off OA. So Olam, there are two parts. If you recall, they want there's Olam Agri and Olam Food Ingredients OFI. The earnings for both are quite similar. I think Olam Agri is slightly bigger. So Olam Agri, so you can assume that Olam now has these two big businesses. Olam Agri was supposed to get listed in Saudi, but I think now with Salik looking to buy back, the valuations is they're going to buy at 4 billion US. So the valuation is about 6 billion, which is Sing dollars, which is or 5 billion, which is actually the equivalent to the whole market cap of Olam now. So if this happens, then of course the stock will skyrocket because they still have Olam OFI, which they want to list anyway. So and the size of OFI is similar to Olam Agri, so it's definitely a positive. Yeah, and the valuations should be around there because Olam Agri, when the first 22% stake they sold to Salik was also around similar levels, and of course Salik not going to buy it at a cheaper price, and after they have to make a write-off on the 22%, I guess. Yeah, those who answer questions, I think this one's answered, right? Can you just mark it as answered? Yeah. What's your take on Olam share price with Saudi interest? Yeah, it's the same. Yeah, thanks. What's your fundamental view on Jardine, Hong Kong Land, and DFI? We don't have any strong views. Jardine Matheson again is very dependent on Indonesian auto sales. I don't have the number of me right now. But for Hong Kong Land and DFI, I think really just have to wait for the China stimulus. I think without the China stimulus, I think to bank on a strong recovery on Hong Kong real estate, I don't think that's happening. With tenant sales weak and then office vacancies surging in Hong Kong, I don't think real estate is going to be strong. But again, there could be a bounce because if you get this big stimulus out of China, which is expected. SMCI, I'm not sure what company. Higher GDP growth, more jobs added, higher than expected inflation, less need to, yeah. You are right in that sense. I think but I think in a way also the Fed has probably kind of cornered himself. So most likely one scenario is that he will cut rates in this coming November meeting, but at the same time maybe guide that there is room for it to pause. I think what has happened is I didn't go through all this, but after the recent there's been a lot of Fed officials mentioning that maybe they can pause a little bit. So I think maybe Powell might hint that there could be a pause in December, which I think the market kind of priced it into. But you're exactly right. I think the GDP was very strong. There's was about 2.8%, almost 3%. Yeah. So one scenario is to watch how Powell guide for the December FOMC meeting. Can you please share about Venture and HRNet? So Venture will be releasing their results on Friday. I don't think there'll be anything exciting for Venture. It's still a value play. I'm not sure if anybody buys electronic stocks because they are value plays, but you can see that there have been some funds in the UK that like this type of stocks. So they pay like 5% yield, and then you got optionality, if there's a big bounce in electronics. For HRNet, I think the jobs market is still going to be sluggish. So I think second half for HRNet is still going to be soft for them. What advantages does Sheng Siong have over dairy farm that they can take over vacated locations and still do well? The main advantage Sheng Siong has is really on fresh food. So fresh food is something which my own view is that DFI doesn't have the formula to compete with Sheng Siong on fresh food. So for Why am I pronouncing it wrong? So for fresh, always remember fresh is a very perishable item, so it's very difficult to manage. Firstly, I think Sheng Siong has directly source all these fresh items. And because they are able to source it, apparently they source it better directly than dairy farm. Then when the food arrives at all these outlets, the other challenge is how do you manage? So one thing they are very good managers. Again, I don't know what's the formula, but they manage to get all this perishable out by selling it cheaper when it comes to the maturity period. So that's one of the strengths is to manage the fresh items, which is extremely difficult because you're talking about something after 2-3 days, the value will come down. So that's the ability to do it. And of course, most of or all of Sheng Siong's, if I'm not mistaken, all of Sheng Siong's shops are in HDB. And you know, HDB, you can no, you don't have to close your shop at, I don't know, 10 a.m. The rental, you don't get squeezed by, I guess, Capitaland and and phrases all the time. So that's the other advantage they have is the fresh and also all HDB shops. Yeah, yeah. Thanks for that question. I think I'll hand it over. Sorry, what's SM? Yeah, I'll hand it over to Zain. Yeah. Oh, sorry, one more last one. Is Keppel missing estimates for revenue, ROE, and EPS? Any concerns? Yeah, I think our view has always been that Keppel Limited's results for 2024 will be weak because they don't have the growth in property development out of China. But I think we factored that in. I think, yeah, because of China weak property development, they're not going to get those earnings. So the weak earnings will continue into the second half. But I think the story for them will be monetization, which I think 2025 should be a stronger year for them because they got more of these assets and available for sale, especially REIT. Yeah, there was an article out. If you do a search, there were some articles out on REIT and by upstream. If you look at the upstream article, they did mention that REIT is actually operationally performing better. Yeah. Thanks for the question. Yeah. Hand it over to you, Zain. Thank you.
Yeah, Zain, maybe I'll just take one more last one before I hand it back to you. I think just now CK asked the question about the dividends. Where, just to clarify that when I was talking about DBS dividends, it was I was saying that it was flat quarter on quarter. Sorry, should have been more detailed when I was talking about that. But year on year, they still increased. So the question was that, you know, what is the difference? Like why do we use year on year and quarter on quarter? You know, sometimes you use year on year, sometimes you use quarter on quarter. Yeah, I understand. So for most of the comparisons we do, we would prefer to use year on year, mainly due to, you know, you remove the effect of like some seasonality, especially for the banks. If you look at it, year end, right? The seasonality, their credit card sometimes might fall off a bit. Or no, certain line items will actually be lower or higher. That's why year on year is usually a better comparison. But why I used it for DBS quarter on quarter for their dividends, mainly due to the fact that they, I think one of the only banks in Singapore that at least they give the dividends, you know, and they look at it at increase every quarter, right? So when they say they're going to increase dividends, they look at what they've given previously, and then they just give it. So for dividends wise, maybe it's a better comparison if you look at it quarter on quarter. If you look at DBS wise, that's why when it was a bit of an upset that they didn't increase their dividends during that the last quarter, but the reason they gave was, you know, due to the CEO change and everything. Yeah, so that was for DBS. Hope that answers that part and clarifies it for you. Okay, Zain, I think I'll hand it over to you for the TA. Thanks.
Okay, thanks, Glenn. I'll share my screen for TA. Okay, I'll answer the Singapore and Hong Kong questions first, and followed by the US ones. So first up is on Yang Zhejiang Financial. And so for Yang Zhejiang Financial, I think for now there's some bit of weakness that's currently in the stock, as the price can't hold a 40 cents support level after a bit of range consolidation. So I think we might see a slight further dip towards the next support level around 38 to 38.5 cents before maybe another slight bounce again. So overall, I think it's still pulling back after this rise at the start of October. Okay, then next one is Hong Kong land. So for Hong Kong land, I think, yeah. So momentum is still quite good prices. Today, yeah, the price is still above the highs of last week, which was 456. I think with that, we could see maybe a little bit more upside to test the resistance closer to about 470. There might be some next resistance level over there. And then afterwards will be the next one will be closer to about 490, which was the previous double top back in February 2022. And so overall, for now, still trending up. Yeah, we could maybe still see price go up a little bit further. Then for AEM, I think nothing too much. Just still quite sideways since price came off this bearish flag over here. Still a bit of weakness for now. I think some resistance will be around 130, 133, 135 the area. And for now, next key support level will be closer to about 124, 123, 124 levels. So I would still expect maybe some sideways to a little bit more further pullback. Yeah. Then for Manulife TA, for Manulife, I think still looks quite sideways for now. We could possibly see a retest of this swing low again, close to about 10.7 cents again. Yeah, since price is still a bit of weakness since the pullback from around 12.2, 12.3 cents area, and price is still unable to get above 11.6 cents over here. Then next one is Jaffa and Comfort Delgro. And for Jaffa, I think for now, yeah, still a bit of a pullback since this gap up over here. We tested this previous resistance around 38.5 cents. So over here we might see some slight bounce, but I expect resistance above 40 cents for now. Yeah. Then but if 38.5 cents cannot hold, then we might see some further weakness towards closer to 37 cents area. And then for Comfort Delgro, I think price for now we might see some sideways since a rebound took place after price retested about 142, 143 previous resistance over here. So currently you're seeing this bounce over here. I'll still expect resistance about 150 to 153. So maybe some sideways consolidation for now. Okay, for Meituan, I think overall for now, price is still rather very sideways as with most of the Hong Kong counters. Over here we can see that support for now is still around 180. The key resistance still around 195 to 200 over there. So I think for now will still likely be quite sideways between this region. Then for the Hang Seng Tech, yeah, for Hang Seng Tech Index, you can see the index is also very sideways for now. You can see just I think past 2 weeks has been just consolidating over here between 4,475 to about 4,660. So I think for now we still likely to see this trend continue. There's a breakdown below this 4,476. Then we might see a retest closer to about 4,330. Now, if there's a break above this range resistance, then we might see some bounce towards closer to 4,860. So overall, still very tight consolidation these past few weeks. Yeah, then for Hang Seng, for the Hang Seng Index, quite similar as well. So price is just sideways between 20.4K to about 21K area. So above 21K, next resistance level will be a bit closer to 21.4, 21.5K. But then below 20.3K, we will have we might see a retest of about 20K. So overall, still also very tight range for Hang Seng Index for now. Question is on Singtel. Okay, for Singtel, I think And that was last Friday, was this gap down, then price we tested a support level around 290, then there was a recovery back up. Today, so retesting this $3.13 level, which was previous support. So we might see a bit of resistance for now, but I will still expect support to come in for now. The current support to be around 1307, 308 for now. So maybe some consolidation still. Since price is still, for this stretch, since second half of September, price is still pulling back lower highs and lower lows. Then for China aviation, I think for now we're likely to see some sort of sideways. Since price has pulled back towards this previous strong resistance at 89 cents to 90 cents area, we can see price is just flattening out and volume has dropped down a lot as well. So just some range bound between the 88 cents to 91 cents for the time being. Then for Bank of China, I think we're still seeing a bit of a consolidation for now still, but overall bullish view is still intact. Since you can see that price is still above previous resistance about 365, and then currently the recent lows was also above this double bottom at 360 as well. So I think for now, if price can get above 376, we might see some bounce towards the current resistance about 387, 395 area. So overall, still quite range bound for now, but the short-term bullish trend is still intact. Okay, then there's a question on the three local banks. First, I'll start off with DBS. So I think for now, DBS is still seeing a bit of a sideways recently, since resistance was still holding at $39.70. This double top, and yeah, it's just basically range bound between 38.60. There's some support from this short-term resistance. So I will expect some sideways consolidation for now before the results. Then for UOB, also quite similar. It's just that the recent resistance is around 32.70, 32.80. Then we are seeing support from this level around 31.80. So just some consolidation as well. Yeah, OCBC also similar. Resistance currently around 1540, 1550, and support is coming in at around 1510. Then next level below is around 1490. So also sideways consolidation for the three local banks. Next question is on Silver Lake Axis. And so for Silver Lake Axis, I think still range bound. Just recently price above this 37 cents, but still kept at 38 cents. So yeah, maybe another consolidation for now. For Q&M, I think Q&M is still looking good. Recently, after this long period of consolidation, there was a breakout over here above 29 cents. The retest held as support. So for now, I will expect some sideways consolidation to come in, perhaps between 29 cents to about 31 cents over here for now. Okay, next question, Aztec. Okay, yeah. So Aztec, in terms of the sell down into perspective, can see that actually broke below this upward support line since May last year. Then price is currently over here. So yeah, actually at this swing low level, around 72 cents. This area between 70 cents to 72 cents, there might be some short-term support coming in for a slight bounce. So I think we might see the sell-off slow down a bit as we approach this previous resistance, which could act as a bit of support level. Then the next support level that was reversible to about 67 cents. So that's for Aztec. Then short-term resistance, I was thinking is probably the some rebound last week. It's around 75 to 77 cents area over here. Will likely be some resistance for the time being. Okay, for Franken, I think for now still a bit of weakness. You can see overall still pulling back gradually since start of October. So for now, I'll expect some resistance is around 120. Then support level will be this 112 to about 116 area over here. So maybe some slight further pullback if this downtrend continues for now. Okay, then back to some of the Hong Kong counters. First up is Baidu 9888. Yeah, so for Baidu, I think price actually retested a bit of the prior resistance over here at $87. We've seen a slight bounce there, just coming off a bit recently again. Yeah, so I think we might see another retest of the recent lows, this 86, 87 support again. See whether we can form a double bottom for price to rebound. Since overall momentum is still slowing down since start of October. Okay, then 9618 is JD. So for JD, I think for now still quite sideways, but we are seeing resistance above 161, which was this swing low support level bounce over here. So price is still unable to hold above this level, so still some weakness for now, but I would expect support to hold for now at 147, 148 is recent also. Maybe some sideways consolidation to take place currently. In 9988 is Alibaba. So Alibaba also starting to do a bit of a sideways, some support coming in around $94. Resistance for now will likely be around $98, $99. So I would still expect a bit of sideways coming for now. Since recently it looks like a bit of a double bottom over here if 94 is able to hold. One, 2, 3, 1, 8, Ping An Insurance. And so Ping An Insurance, so quite sideways recently. Main resistance is around $50, 50 to 52 around here. But support is holding around 46, around 46 over here. So also quite sideways for now, we expect. The next one is Sembcorp Industries. The Sembcorp Industries are quite extended period of pullback over here. Today, possible first this green candle over here upon retesting the previous resistance at around $5 over here. So we might see some short rebound, but I would expect some resistance to still come in at close to 520 about there. There might be some resistance. And for Keppel, for Keppel, I think overall still quite sideways for now, but still some weakness going on since it reached this 675 over here, because you can see that this recent rebound after the results, it tested 650, which was this support level, but still holding out as resistance. And we see price came back down to this support, again close to 630, 638. And so maybe still a bit of a sideways consolidation going on over here. And if it breaks below 635, then we might see test lower levels like 620. Okay, for Delphi, I think still for now looks like still a bit of a sideways consolidation going on. But positive is that potential ascending triangle over here. We're still forming higher lows into resistance at 87 cents. So if it's able to hold maybe in 5.5 cents and above, I think still more positive. And if you can break above this level, you might see price test the next resistance at around 90 cents again. Yeah, but for now, still looks like a bit of a consolidation. Next one is on Sanders REIT also bit of weakness since price still below 277 support. And we tested some previous resistance at around 265, seeing a bit of rebound. But I will still expect this pullback to continue for now. Some resistance will be at this recent breakdown level around 275 there. Then below this level, next support level will be closer to about 260 level. And for Genting, some bounce today after retesting this support level around 83 cents over here again. But I would expect resistance to come in from this previous breakdown level around 87 cents. And after we might see a bit of a sideways consolidation thereafter. Okay, for iFast, I think still seeing some weakness today since the breakdown of $7.60, which is this key support level that was strong resistance previously, then also below 737 for now. So I think we might still see some pullback take place, maybe towards the next support level around close to 715. And we see whether there's some support that could come in. Then ST Engineering. ST Engineering also some weakness recently. In the short term, there was a range consolidation between around 460 to 480, and a bit of a breakdown Wednesday last week. We might see some slight further pullback, bit towards like 440 about there. And I think we'll get some support overall in the mid to longer term, it looks like just trading within this uptrend channel. So if it dips to maybe like close to 440, we get the support of this prior resistance as well as this channel support over here that might see the stock do a bit of a bounce from here. Next question is on Wilmar. So for Wilmar, I think it looks like a pullback. We have a pullback that broke a few support levels at 320 as well as 313 over here. So if price is unable to get back above 313, you might still see a bit of slight pullback towards the previous day's range support level around close to $3, since we are still seeing some weakness for now. Yeah, next one, MLT. For MLT, some rebound for now at the support level of 132. I will expect resistance to come in around 137 to 138 area. So we might see some slight bounce, but still some short-term resistance ahead. And for Suntec REIT, still some weakness for now. I think we might see some continued pullback towards the next key support level, closer to about 115, 112 to about 115 area. Then we might see some bounce afterwards. SIA, I think for now, just some sideways consolidation. With support is around 635 over here to 640. Then resistance is closer to 655. So just consolidating sideways. Then for CICT, a bit of weakness currently as price is below this previous resistance as a support level of 59 cents. So I think for now we might we might see a bit of a pullback towards maybe 56.5 cents. This next support level. Yeah, 55 cents to 56.5 cents will be next support area. I'll just take one more question. This one CICT. Yeah, for CICT, we're still seeing a bit of weakness for now, as it's below this short-term uptrend channel in blue. Then also broke below recent consolidation recently at $2.08. Currently seeing a bit of a support from this swing low level at around $2. Next support level downwards will be closer to about 195, 196. Then for now, resistance will likely see at this 207, 208. So maybe some slight bounce and maybe consolidation again. Yeah, so unable to take all the TA questions in view of time, but feel free to post them in our P3 TA community, then I'll answer them. Or if you have time, you can join the 8:15 USTA webinar tonight, where I'll be sharing on the US counters as well. Yeah. So I'll have a time back. My colleagues, if there are any more questions, thanks.
Yeah, thanks, Zain. Sorry, the other question was SMCI means super micro. Yeah, yeah, I don't think you want to go near. I don't think there's any way. So the question is, any way back for SMCI? I don't think there's any way back. The auditor basically said they can't trust the management. There is an investigation going on, and they didn't file their annual report. Yeah, it's those things where someone call you from behind, don't even look back. Yeah, and I don't. Okay, but anyway, yeah, I think that's something that totally to avoid. Yeah, it's really a major. Without stating the obvious, a major red flag when auditors say you don't trust the company's numbers. So sometimes people won't ask us, no, as an analyst. I mean, as much as we can only rely on what the analyst tells us. And imagine if what the auditor tells us. And imagine if the auditor also say they can't trust the numbers. Can imagine how bad that can be. But anyway, thanks everyone for your time, and thank you for your questions. And I hope to see everyone next week, and again wish everyone have a wonderful week ahead, and thank you everyone for attending and spending time with us. Thank you, everybody.